Breaking the cycle of predatory payday loans, why banning them protects vulnerable communities. Payday loans are often advertised as a quick financial fix, providing small amounts of cash to people in need with minimal requirements. However, for the millions of low-income individuals who turn to these short-term, high-interest loans, the reality is far more harmful than helpful. Rather than offering a temporary solution to financial problems, payday loans often trap borrowers in a vicious cycle of debt due to exorbitant interest rates and fees. The predatory nature of these loans, combined with their accessibility, makes them a significant issue for vulnerable populations struggling to make ends meet. Banning payday loans or heavily regulating them would offer much-needed protection for individuals at risk of financial exploitation. By eliminating these predatory lending practices and providing safer alternatives, such as low-interest loans through credit unions or government programs, society can reduce long-term debt burdens and foster financial stability for vulnerable communities. While opponents, particularly from the lending industry, argue that payday loans serve an important function for those in immediate need, the evidence overwhelmingly suggests that the risks far outweigh the benefits. Consumer protections and financial literacy programs can provide more sustainable and fair solutions. Payday loans are typically marketed as short-term, high-interest loans that borrowers can use to cover expenses until their next paycheck. In theory, this may sound like a practical solution for individuals facing urgent financial needs, such as paying rent or medical bills. However, payday loans come with a dark side. Their exorbitant interest rates and hidden fees often make it nearly impossible for borrowers to repay the loan on time without falling into further debt. According to the Consumer Financial Protection Bureau, CFPB, the average payday loan carries an annual percentage rate, April, of nearly 400%. This means that even a small loan can quickly balloon into an unmanageable debt burden. For example, a borrower who takes out a $500 payday loan may end up paying $1,000 or more in interest and fees over time, especially if they cannot repay the loan within the original short-term period. This is the core of the payday loan trap. Borrowers often have to take out new loans to repay the original one, leading to a cycle of debt that can last months or even years. Anecdotes from borrowers paint a grim picture of how these loans can devastate lives. Consider the case of Jessica, a single mother who took out a payday loan to cover emergency medical expenses for her child. The initial loan seemed manageable, but when her next paycheck came, she couldn't afford to both repay the loan and cover her living expenses. She rolled over the loan, accumulating more fees and interest. Before long, Jessica was trapped in a cycle of debt, with more than half of her income going toward paying off payday lenders. Her experience is not unique. The CFPB estimates that 80% of payday loan borrowers either default on their loans or renew them multiple times, paying far more in fees than they initially borrowed. Banning payday loans or regulating them heavily would have several positive effects on vulnerable communities. First and foremost, it would protect low-income individuals from financial exploitation. Without access to payday loans, many individuals would no longer be trapped in cycles of debt that keep them in perpetual financial instability. Banning these loans also encourages the development of safer, more sustainable alternatives, such as low-interest loans provided by credit unions or government-backed programs. Credit unions, in particular, have emerged as a viable alternative for individuals who need short-term financial help. Unlike payday lenders, credit unions are non-profit institutions that often provide low-interest, small-dollar loans to their members. For example, the National Credit Union Administration, NCUA, has created a program called Payday Alternative Loans, PALS, which offers loans with significantly lower interest rates and more reasonable repayment terms compared to traditional payday loans. These loans help individuals cover emergency expenses without the risk of falling into unmanageable debt. Government programs can also play a role in providing alternatives to payday loans. Some states and municipalities have implemented pilot programs that offer small-dollar, low-interest loans to individuals who are typically excluded from traditional banking services. For example, in 2019, the state of Virginia launched the Virginia Small Dollar Loan Program, which provides loans with interest rates capped at 36% April, far lower than the rates offered by payday lenders. In addition to offering safer financial products, banning payday loans can encourage a shift toward greater financial literacy. Many borrowers turn to payday loans because they lack access to traditional banking services or are unfamiliar with how to navigate financial systems. By promoting financial literacy through education and outreach, communities can help individuals better understand their financial options and make informed decisions that don't lead to cycles of debt. Despite the clear benefits of banning or regulating payday loans, opposition to such measures remains strong, particularly from the lending industry. Payday lenders argue that their services provide a necessary lifeline for individuals who cannot access traditional credit or banking services. They claim that without payday loans, low-income individuals would have no choice but to turn to more dangerous alternatives, such as loan sharks or unregulated lending markets. While this argument may sound compelling, it overlooks the fact that the payday lending industry itself is a major contributor to financial instability. Payday loans do not address the root causes of financial insecurity. Instead, they exacerbate it by trapping individuals in debt. Moreover, research has shown that in states where payday loans have been banned or regulated, individuals have not turned to illegal lending. A study by the Pew Charitable Trusts found that in states where payday loans were banned, borrowers did not resort to loan sharks. Instead, they turned to friends, family, and credit unions for help. Critics of payday loan bans also argue that regulating the industry would result in job losses and the closure of payday lending businesses. However, the broader economic and social benefits of eliminating predatory lending far outweigh the potential short-term losses in the lending industry. By protecting vulnerable individuals from debt traps, society can reduce long-term financial burdens, promote economic stability, and reduce the need for government assistance programs that often serve individuals who have been bankrupted by payday loans. The battle between consumer protections and predatory lending practices is not new. Throughout history, societies have struggled to balance the need for accessible credit with the risk of exploitation. In ancient Rome, the practice of charging excessive interest was known as usury, and laws were passed to limit how much lenders could charge. Similarly, during the Great Depression in the 1930s, the U.S. government implemented a series of financial reforms to protect individuals from unscrupulous lenders and banks that had contributed to the economic collapse. More recently, the passage of the Dodd-Frank Act in 2010 and the creation of the Consumer Financial Protection Bureau, CFPB, marked a major step toward regulating predatory financial practices in the U.S. These reforms were designed to protect consumers from deceptive and unfair lending practices, including those used by payday lenders. While payday lending remains legal in many states, the CFPB has introduced regulations to limit the number of times borrowers can renew loans and require lenders to assess a borrower's ability to repay before issuing a loan. Banning payday loans is not about limiting access to credit. It's about protecting vulnerable individuals from predatory practices that exploit financial desperation. Payday loans trap borrowers in cycles of debt, with exorbitant interest rates and fees that are nearly impossible to escape. By eliminating these loans and offering safer, more affordable alternatives through credit unions and government programs, society can help individuals regain financial stability. While the lending industry may resist these changes, the broader benefits of protecting consumers far outweigh the risks. Financial literacy programs, coupled with access to low-interest loans, provide a sustainable path forward, one that prioritizes the long-term well-being of individuals over the short-term profits of payday lenders. Ultimately, banning payday loans is a critical step toward building a more just and equitable financial system for all.